Be me, 44, Senior Investment Analyst at Henderson Capital Management. We're a big deal in the investment world. $50 billion assets under management. Institutional clients, pension funds, university endowments, family offices. Been around for 40 years. Reputation for steady, conservative returns. I've been here for 18 years. Worked my way up from junior analyst. My job is evaluating investment opportunities. Research companies, analyze financials, recommend buys and sells. We're not flashy. We don't chase trends. We focus on fundamentals, long-term value, risk management. Our typical client is a state pension fund. Teachers, firefighters, cops depending on us for retirement. We take that responsibility seriously. Average return over 40 years is 9.2% annually. Not spectacular, but consistent, reliable, safe. That's our brand. That's why clients trust us. Then 2 years ago, the board decided we needed to modernize. Hired a chief ESG officer to lead our sustainability initiatives. Woman named Diana. She's 39, comes from nonprofit world. Background in activism, climate advocacy, social justice. Harvard MBA, lots of credentials, lots of connections. Zero experience managing actual investments. Board thought that was fine. ESG is about values, not just returns. I'm skeptical from day one. Diana's first week, she calls an all-hands meeting. Presents her vision for ethical investing. We can no longer ignore our moral responsibility. Every dollar we invest is a vote for the kind of world we want. And I'm here to make sure we're voting correctly. She shows a slide, our current portfolio breakdown. Energy sector, 12% of holdings. Oil companies, natural gas, some coal. These stocks have been printing money for us. ExxonMobil up 23% this year. Chevron up 19%. Diana, this is unacceptable. We're profiting from climate destruction. Me, we're profiting from energy demand. Diana, same thing, and it needs to stop. She continues through the sectors. Defense contractors, 8% of holdings. Lockheed, Raytheon, Northrop Grumman. All solid performers, stable dividends. Diana, we're funding war machines. Another analyst, we're investing in national defense. Diana, we're divesting into discussion. Traditional banks, 15% of holdings. JP Morgan, Bank of America, Wells Fargo. She has problems with all of them. Predatory lending, lack of diversity, fossil fuel financing. By the end of the presentation, she wants to divest from 35% of our portfolio. $17.5 billion in holdings. These are our best performers. Combined, they're returning 14.6% annually, way above our 9.2% average. I raise my hand. What do we replace these with? Diana, ESG-compliant alternatives. Solar companies, wind energy, ethical banks. Companies with diverse boards and progressive policies. Me, we're the returns on those. Diana, returns aren't everything. We have a fiduciary duty to the planet, not just to profits. Me, actually our fiduciary duty is to our clients. Pension funds, endowments, they need returns. Diana, they need a livable planet more. Meeting ends, we're all concerned. Talk among the analysts afterward. She's going to tank our performance. We can't just dump our best holdings. But Diana has board support. They hired her specifically to do this. ESG is trendy. Boards want to look progressive. Don't matter that it might hurt returns. Next month, Diana presents her divestment plan to the board. Calls it Project Clean Slate. Phase 1, immediate divestment from fossil fuels. Sell all oil, gas, coal stocks over 90 days. Phase 2, divest from defense, traditional banks, problematic companies. Phase 3, reinvest in ESG-aligned alternatives. Board approves it unanimously. One board member asks, what about client consent? Diana, we have discretionary authority. Clients hired us to make investment decisions. This is an investment decision, except it's not really. It's an ideological decision masquerading as investment strategy. We start getting calls from clients. They've read the press release about our ESG initiative. California Teachers Pension. Are you selling our energy holdings? Me? Yes, that's the plan. Client. Those are our best performers. Me? I know, but the new ESG mandate requires it. Client. We didn't sign up for ESG mandates. We signed up for returns. Me? I understand. I'll relay your concerns. Same conversation 20 times over. Clients are not happy, but Diana doesn't care. They'll thank us in the long run. March, phase 1 begins. We start liquidating energy holdings. $6 billion in oil and gas stocks. Market notices it's a huge sale. We're dumping quality assets. Other investors snap them up. ExxonMobil, we sell at $112 per share. Chevron at $168. ConocoPhillips at $124. All solid companies, all making money. Diana's celebrating. We're divesting from destruction. I'm watching the prices. The stocks we just sold keep going up. By May, ExxonMobil is at $131. Chevron at $189. We left $400 million on the table in 2 months. Diana, short-term fluctuations don't matter. Me, that's $400 million of our clients' money. Diana, they'll make it back in ethical investments. Except we haven't bought the ethical investments yet. We're sitting on $6 billion in cash, while Diana evaluates ESG-compliant alternatives. She's picky, really picky. Rejects companies for tiny infractions. CEO made a donation to wrong political party. Board isn't diverse enough. They use plastic in their packaging. Meanwhile, our cash is earning 0.5% in money market, while the stocks we sold are up another 8%. June, she finally picks replacements. Solar companies mostly, some wind energy. NextEra Energy, First Solar, SunPower. Problem is, these companies are expensive. Trading at 40x earnings, some have no earnings at all. Traditional value metrics say they're overpriced. Diana, you can't apply old metrics to new energy. These companies are changing the world. Me, these companies are losing money. Diana, they're investing in growth. We buy $6 billion worth. Within a month, solar sector crashes. Government subsidies get cut. Interest rates rise, growth stocks tank. Our solar holdings down 18% in 4 weeks. The oil stocks we sold, up another 12%. We're now underperforming our benchmark by 31%. Worst quarter in company history. Clients are furious, calling nonstop. Texas teachers' retirement. What the hell is happening? Me. We've implemented an ESG investment strategy. Client. We've lost $140 million in 3 months. Me. It's a transition period, should stabilize. Client should. We need certainty, not hope. They pull $800 million. First major withdrawal in company's 40-year history. July. Board meets to discuss the situation. Performance numbers are brutal. YTD were down 6.3%. S&P 500 is up 11.2%. We're underperforming by 17.5 percentage points. That's catastrophic for an institutional fund. Board asks Diana to explain. She shows a presentation. Short-term volatility, long-term vision. Argues that ESG investing takes time. The market hasn't caught up to the moral imperative yet, but it will, and will be positioned perfectly. Board member, our clients are withdrawing funds. Diana, clients who don't share our values. We're better off without them. Another board member, their pension funds. Teachers, firefighters, public servants. They don't care about our values. They care about retirement. Diana, then they're part of the problem. I'm sitting there thinking, this is insane. She just called our clients the problem. These are people depending on us for their futures, and she's sacrificing their returns for ideology. But half the board is nodding along. We need to stay the course. ESG is the future. Meeting ends, no course correction. We're continuing the purge. August, phase 2 begins. Divest from defense contractors. Sell Lockheed Martin, Raytheon, Northrop, another $4 billion in sales. These stocks are also performing well. Lockheed up 16% YTD. We sell, stock keeps climbing. By September, it's up 24%. We missed another $320 million in gains. Diana's replacement picks, ethical tech companies, social media platforms with strong DEI policies, renewable infrastructure firms. We buy $4 billion worth. 2 weeks later, tech sector corrects. Our holdings down 14%. The defense stocks, we sold up another 7%. September, we're down 11.2% YTD. Market is up 14.1%. We're underperforming by 25.3 percentage points. Clients are hemorrhaging. University of Michigan Endowment pulls $1.1 billion. Unacceptable performance, breach of fiduciary duty. New York State Pension pulls $900 million. Colorado public employees pull $400 million. In 3 months, we've lost $3.2 billion in assets. Companies in crisis mode. October, emergency board meeting. CEO is panicking. We're losing our client base. Presents the numbers. We've lost $3.2 billion in withdrawals. Performance is the worst in company history. Reputation in the industry is destroyed. Shows client feedback. Henderson has abandoned fiduciary responsibility. They're running an activism fund, not an investment fund. We trusted them with our members' futures. Board member asks Diana, "What's your response?" Diana, "These clients don't understand long-term ESG value." Board member, "They understand 25% underperformance." Diana, "The market will correct. ESG investing is the future. We're just early." Board member, "Early to what?" Bankruptcy. Another member, "We've been in business 40 years. Never had a quarter this bad, let alone 3 in a row." Diana, "Because you've been complicit in climate destruction, in funding wars, in supporting unethical companies." I'm fixing that. Board member, "You're destroying the firm." CEO finally speaks up. Diana, "I think we need to pause the ESG transition, reevaluate our approach, maybe rebalance the portfolio." Diana, "Absolutely not. We're committed to this path." CEO, "We're committed to our clients." Diana, "Then you're committed to the wrong things." She quits on the spot. "I won't be part of backsliding into unethical investing." Walks out of the meeting. Board sits there stunned. CEO, "Well, that solves one problem." Board member, "But not the big one. We're still down 25%. November, damage control begins. New interim CIO, veteran portfolio manager. His assessment: "This is a disaster. We need to rebalance immediately." Starts unwinding the ESG positions. But we're selling at a loss. The solar stocks we bought at premium prices. Now down 35% from our purchase price. We sell, take massive realized losses. Try to buy back the oil and defense stocks. But they're way more expensive now. ExxonMobil we sold at $112. Now it's $156. Lockheed we sold at $465. Now it's $548. We buy back in, but with 30 to 40% premiums. December, final numbers come in. Year-end performance, minus 8.7%. Benchmark performance, plus 18.3%. Total underperformance, 27 percentage points. Assets under management, down from $50 billion to $46 billion. Client withdrawals for billion-dollar total. Realized losses from ESG trades, $2.1 billion. Worst year in company's 40-year history. By a lot. January, I'm still here somehow. About 40% of the investment team got laid off. I survived because I opposed the ESG push. Documentation shows I raise concerns. New management keeps me as example of we should have listened. We're trying to rebuild. But reputation is shattered. Industry knows what happened. Henderson went woke and went broke. Recruiting is impossible. Top analysts won't join us. You're the ESG disaster fund. Client acquisition is dead. Pitch meetings go nowhere. Why should we trust you after last year? The firm that took 40 years to build, destroyed in 9 months. All because Diana prioritized ideology over returns. Diana lands on her feet, of course. LinkedIn, thrilled to announce my new venture. ESG Investment Consulting, helping firms transition to ethical investing. She's doing speaking tours. $75,000 per appearance. Lessons from leading ESG transformation. I watch one online. Can't help myself. She talks about Henderson as a success story. We successfully divested from fossil fuels. Zero mention of the $4 billion in withdrawals. Zero mention of the 27% underperformance. Zero mention of the clients whose retirement funds we damaged. Just proud declarations about standing firm on values. Someone in the audience asks, what about the performance issues that resulted? Diana, short-term volatility is expected. Real change requires courage. The market will eventually reward ethical investing. She still doesn't get it, or doesn't care. For her, this was never about returns. It was about making a statement. And she made it with other people's money. Pension funds, endowments, retirement savings. She gambled with all of it to prove an ideological point and lost. Today, a year later, Henderson is still struggling. Assets under management down to $43 billion. Lost another $3 billion this year to continued withdrawals. Some clients stuck with us, can't easily move. But they're not happy, not recommending us, not adding new money, just waiting for contract periods to end. So they can leave too. I'm looking for new jobs. But Henderson on your resume is a scarlet letter now. Interviews always come back to it. What happened there? I explain I oppose the ESG push. Some believe me, most don't. You were part of the team. You share responsibility. Fair, I guess. I didn't quit, I stayed. Try to fix it from inside. Didn't work. Meanwhile, Diana's consulting business is booming. Just landed a contract with a major state pension fund. $500,000 to evaluate ESG integration opportunities. I want to call them, warn them. She destroyed our firm doing this. But what's the point? They'll find out themselves. When their performance tanks. When their beneficiaries revolt. When they realize that ESG isn't about returns. It's about ideology. And ideology doesn't pay retirement benefits. The teachers whose pension fund we managed lost an average of $14,000 each in 1 year from our ESG experiment. $14,000 closer to retiring broke because Diana decided fossil fuels were immoral. The firefighters in the Colorado Fund lost $8,000 per person on average because Diana decided defense contractors were unethical. These are real people with real retirements at stake, and we failed them, not because of market crashes, not because of bad luck, because someone decided that virtue signaling mattered more than fiduciary duty. That's what kills me most. We had one job, grow our clients' money, preserve their futures. Instead, we used their money to make political statements and called it progress. Feminist portfolio manager forced ESG compliance. Firm lost $4 billion. Not overnight, took 9 months. But the result was the same. Clients fled, performance tanked. 40-year reputation destroyed. For what? So Diana could feel good about divesting from oil? So the board could virtue signal about climate? So we could claim we were ethical investors? None of that matters. To the teacher who's $14,000 per, to the firefighter working extra years, to the university student whose scholarship got cut because the endowment can't afford it anymore. They don't care about our values. They care about their futures. And we destroyed those futures in the name of ESG. That's the lesson that nobody wants to learn, because admitting it means admitting that good intentions don't justify catastrophic results. 6 months after Diana left, I run into her at a finance conference. She's there as keynote speaker. The future of ethical investing. I'm trying to network, find a new job. See her in the hallway between sessions. She sees me, walks over smiling. Hey, how's Henderson doing? Like she's asking about the weather. Me, we're down to $43 billion AUM. Lost another $3 billion in withdrawals this year. Diana, oh, that's unfortunate. Unfortunate, like it's a coincidence. Like she didn't cause it. Me, it's a direct result of the ESG strategy. Diana, or a result of leadership not fully committing. If they'd stayed the course, market would have corrected. Me, Diana, we lost $4 billion in client assets. Teachers' pensions, firefighters' retirements. Diana, and how much did we save the planet? Here. She's serious. Me, we didn't save anything. We sold oil stocks to other investors who kept drilling. All we did was lose our clients' money. Diana, that's short-term thinking. In 10 years, ESG will be the only game in town. Me, in 10 years, Henderson might not exist. Diana, then it'll be replaced by something better. Creative destruction, that's capitalism. She walks away to prepare for her speech. I sit in the back and watch. She gets a standing ovation, talking about courage, conviction, moral leadership. Half the audience is nodding along. The other half is checking their phones. Probably portfolio managers who know better. I grab coffee after with an old colleague. Guy named Marcus used to work at Vanguard. He heard about Henderson. Man, that was brutal what happened to you guys. Me, you have no idea. Marcus, actually I might. We're getting pressure to go harder on ESG. Me, don't do it. Marcus, it's coming from the top. New board members, they want to make a statement. Me, tell them to look at our numbers. Marcus, they don't care. They say ESG is a moral imperative. Me, fiduciary duty is a legal imperative. Marcus, try telling them that. He shows me internal memos. Same language Diana used. Moral responsibility to the planet. Values-based investing. Long-term vision over short-term profits. Me, this is exactly how it started with us. Marcus, what should I do? Me, document everything. Every objection you raise, put it in writing. When this blows up, and it will, you want evidence you try to stop it. Marcus, you think it'll blow up everywhere. Me, I think ESG works as one factor among many. But when it becomes the only factor, when ideology overrides returns, it blows up every time. 3 months later, Marcus emails me. Subject, you were right. His firm forced through ESG divestments. Sold $8 billion in energy and defense. Bought renewable and ethical alternatives. First quarter results just came out. Down 9% while market is up 6%. 15-point underperformance. Clients are already complaining. Marcus, board is doubling down, saying we need to educate clients on ESG value. Me, get out now. Marcus, already interviewing. That's the thing about these disasters. They're predictable. You can see them coming. But the people in charge don't want to hear it. They're true believers. And true believers don't change their minds, even when the evidence is overwhelming. I finally land a new job. Smaller firm, $12 billion AUM. They're ESG skeptical after watching Henderson implode. Interview process, CEO asks me, what's your take on ESG investing? Me, it's fine as one factor in investment analysis. Companies with good governance often perform better. Environmental risks are real financial risks. But the moment it becomes ideological, the moment returns don't matter. You're not investing anymore, you're activism. CEO, that's exactly right. We lost a pitch last month. Client wanted pure ESG. We said no. Me? Good. CEO, cost us $400 million potential AUM. Me? Cost Henderson $4 billion actual AUM. You made the right call. I start the new job. It's refreshing. Focus on fundamentals, returns, risk management. Nobody's talking about saving the planet. Just about growing clients' money responsibly. That's what this job is supposed to be. Year 2 after the disaster, Henderson makes news again. Not good news. SEC investigation into breach of fiduciary duty. Class action lawsuit from pension funds. Mismanagement and ideological investing cost retirees billions. Lawsuit alleges we prioritized ESG over returns. Violated our duty to maximize client value. They're going after the board, the CEO, and Diana, even though she left. Her deposition is public record. Lawyer, did you prioritize ESG compliance over investment returns? Diana, I prioritized ethical investing over short-term profits. Lawyer, so yes, ESG over returns? Diana, I reject the premise that those are opposed. Lawyer, your fund underperformed by 27 percentage points. Diana, in 1 year, yes. Lawyer, cost clients $4 billion in withdrawals. Diana, clients who didn't share our values. Lawyer, pension funds for teachers and firefighters. Diana, yes. Lawyer, and you think they don't deserve maximum returns? Diana, I think they deserve a livable planet. Her lawyer objects. Off the record, he probably told her to shut up. But she can't help herself. She genuinely believes she did the right thing. Even now, facing a lawsuit, even with all the evidence of damage, she'd do it again. The lawsuit settles 18 months later. Henderson pays $340 million to affected clients. Doesn't admit wrongdoing, but agrees to compensation. Board members personally contribute $15 million. Diana contributes nothing, says she has no assets. Probably true. She spent everything on lifestyle. Speaking fees dried up after the lawsuit. Nobody wants ESG advice from someone getting sued over it. Last I heard, she's working in a nonprofit again, making $90,000 back where she started. Except now she's infamous in finance circles. The woman who destroyed Henderson. Can't escape it, but she still posts on LinkedIn about ethical investing. Still thinks she was right. Still blames short-term thinkers for not understanding. Henderson today, 3 years later, still exists, but barely. Down a $28 billion AUM. Lost more than half the assets from peak. Laid off 60% of staff. Moved to smaller offices. Reputation is permanently damaged. The firm that went woke and went broke. New management is trying to rebuild, focusing on performance, fiduciary duty. But clients remember. Industry remembers. Takes decades to build trust. Takes months to destroy it. They'll probably never recover to what they were. 40 years of careful reputation building. Destroyed in one ideological crusade. I think about the teachers a lot. The California teachers' pension lost $380 million with us. That's 127,000 teachers. About $3,000 each in losses. Some of them were close to retirement. Had to work extra years to make it up. Some couldn't, retired with less. All because Diana thought fossil fuels were immoral. I think about the firefighters. Colorado lost $240 million. Firefighters who run into burning buildings. Risk their lives every day. We risked their retirements. For an ideology. I think about the university students. Michigan's endowment lost $180 million. That's scholarships not given. Research not funded. Students taking on more debt. Because we decided ESG mattered more than returns. That's what people don't understand about finance. It's not just numbers on a screen. It's real people's futures. Every percentage point matters. Every dollar lost is someone's retirement, someone's education, someone's security. And when you gamble with that, for ideology, for virtue, signaling, for whatever, you're not brave. You're not moral. You're negligent. Diana thought she was saving the world. She was just destroying retirements. And the world kept spinning. Oil companies kept drilling. Defense contractors kept building. All that changed was, our clients got poorer, and Diana got famous. For about 15 minutes, feminist portfolio manager forced ESG compliance. Firm lost $4 billion overnight. Well, over 9 months. But the damage was permanent. Clients gone, reputation destroyed. Lawsuits, settlements, layoffs. Careers ruined, retirements damaged. All for what? So we could feel good about divesting? So we could claim moral superiority? So Diana could give TED Talks? None of it mattered.